Silver's options market is pricing more explosive potential right now, at $74, than it did when silver was trading at $121 just 3 weeks ago. Read that one more time. 30-day implied volatility on CME silver options is currently more than 10 points higher than when this metal was sitting at an all-time peak. Convexity spiked, Skew spiked, simultaneously. And mainstream financial media covered it the same way they cover everything that doesn't fit the narrative. They didn't. OG John XX here. Here's what they don't tell you. When implied volatility rises as price falls, it means the options market is not pricing a continuation of the move down. It's pricing a reversal of historic magnitude. The people who trade volatility for a living, the ones who sit on the other side of these contracts, they are not betting on $60 silver. The math in those contracts says something completely different, and that math is publicly available, completely free, updated daily on the CME website. The ones who've already pulled it are in the comments right now not asking questions. They're adding context I haven't covered yet. That's the difference between a viewer and a community. If that's you, you already know whether to subscribe. I'm not going to ask. Here is what the data actually shows. Silver Western Spot, $74. Futures, $74. Shanghai Spot, $86. Shanghai Futures, $88. A $12 premium holding firm in the East, even as Western paper price collapses 40% from the January peak above $121. Paper says crash. Physical says something completely different. That $12 East-West gap is not a curiosity. It is the physical market publicly refusing to accept Western paper pricing as real. But here is the data point that stops analysts cold. Shanghai physical silver is currently trading at nearly $100 per ounce on its own exchange. That is a 20% premium above the paper derivative contract on the same exchange, in the same city, priced in the same currency. This is not an East versus West story. This is physical versus paper on a single exchange. The shortage is that severe. And that data is publicly available free through exchange reporting. Pull it yourself. March silver open interest sits at 58,770 contracts. 294 million ounces of paper silver. 8 trading days remain until first notice day on February 27th. What should be happening by now, according to every historical pattern, is a mass roll. Positions unwinding. Open interest collapsing as traders exit before physical delivery begins. It is not happening. Open interest is completely unmoved, with the clock running down hard. Either the roll hasn't started, it's deliberately delayed, or certain players are entirely comfortable holding 294 million ounces of paper silver within 8 days of being asked to deliver physical metal. When open interest holds this elevated this late, it stops being a rollover schedule question and starts becoming a genuine exchange liquidity question. Pull CME open interest data yourself, updated daily, publicly posted, completely free to verify. Now zoom out. Because implied volatility doesn't exist in isolation. 3 dates are now converging in a 7-day window. February 20th, SLV options expiry. February 24th, Silver Futures American options expiry. Same day Shanghai reopens after Lunar New Year closure. And February 27th, first notice day, when physical delivery begins against 294 million ounces still open. That 3-day stack is not calendar coincidence. Each date is a pressure point. Together they form a sequence where volatility can only find one outlet. Understand why options traders are paying attention to this the way they are. When silver was at $121 and volatility was lower, the market was essentially saying the move was orderly, expected, and priced. When silver is at $74 and volatility is higher, the market is saying what comes next has not been priced. The options market has a long track record of being early. Not always right, but early. And right now those contracts are screaming. Now look at what's happening in the industrial world underneath this. Silver is the most electrically conductive element on the periodic table. Every solar panel, every EV battery system, every AI data center, every piece of military electronics requires silver, with no viable substitute at industrial scale. 1 physical ounce of silver currently costs less than a pair of Nikes. That pricing disconnect between fundamental industrial utility and paper market price is the direct consequence of decades of concentrated short selling in the futures market, the exact market that is now sitting on 294 million ounces of unrolled open interest 8 days from delivery. Mine CEOs are fielding direct calls from major industrial buyers who want to skip the exchange entirely. arrangements reportedly involving hundreds of thousands of ounces monthly, at premiums reaching 20% or more above spot for guaranteed physical delivery. Samsung reportedly already executed exactly this type of direct arrangement. When manufacturers whose production lines depend on physical silver stop trusting the paper market to deliver, they don't file complaints. They build a parallel market. And that parallel market prices silver based on actual scarcity, not on what a futures contract says it's worth. Pull back even further. U.S. national debt is officially projected to surge $2.44 trillion per year over the next decade. Total debt reaching $64 trillion by 2036. Double current levels. Triple pre-pandemic levels. Annual interest costs alone doubling to $2.1 trillion. And that projection assumes zero recession across the entire decade. Every major global currency is simultaneously hitting new all-time lows priced in gold. Not just the dollar. British pound, euro, yen, Swiss franc. All of them. Mainstream media frames this as a metal story. It is a currency story. The dollar is simply the most recent and most visible casualty. Taleb wrote in The Black Swan about systems that appear stable for extended periods, quietly accumulating hidden fragility beneath the surface, then breaking catastrophically the moment that fragility finally expresses itself. The U.S. debt trajectory is not a future problem waiting to arrive. It is a present mathematical reality expressing itself right now through currency debasement, visible to anyone who reads the primary source documents, instead of accepting headlines about strong economic fundamentals. Big tech credit default swaps outstanding jumped nearly 400% from $2.2 billion to $10 billion in just 13 months. A year ago, those CDS contracts on major tech names essentially did not exist. Now, the AI debt binge that created leverage across the entire sector is being priced for default risk at scale. Bitcoin fell in lockstep with equity weakness. Risk-off is hitting every asset class simultaneously. That is the environment where assets with zero counterparty risk become the final destination, even when they absorb initial hits in the liquidity flush that precedes the rotation. Now, the bearish case deserves honest examination, because this is financial warfare education, not a one-sided sales pitch. $1.28 trillion wiped from gold and silver in 6 hours proves the paper market retains full power to override physical fundamentals in compressed timeframes, regardless of shortage data. Silver down 40% from its January high is real technical damage, not a minor pullback. Historical COMEX delivery averages near 5% of open interest, which means most of those 294 million paper ounces rolls, or settles cash, exactly as it has in every previous cycle. Implied volatility spikes can resolve quietly if the naked short position successfully reloads during the Shanghai closure window. And housing at its worst affordability since 2008 signals the kind of broad economic stress that forces asset liquidation across everything, metals included, regardless of underlying fundamentals. That is the bear case stated honestly. Now here is what the complete picture shows. Shanghai physical trading, 20% above paper price on the same exchange, while Western price simultaneously collapses. 8 days to first notice day, with open interest completely unmoved against every historical pattern that shows mass rollover well before this point. Implied volatility 10 points higher at $74 than it was at $121. The options market pricing more explosive potential at the lows than at the all-time peak. 3 critical dates stacking, February 20th through 27th, with zero buffer between them. Industrial buyers routing around COMEX at 20% premiums, with Samsung already executing direct arrangements. Every major global currency at new all-time lows against gold simultaneously. $64 trillion in official debt projections, with interest costs doubling as the government's own baseline assumption. And big tech default risk that didn't exist 13 months ago, now priced at nearly $10 billion. These are not separate stories running in parallel. They are one story about a system under simultaneous pressure at every single stress point at the same time. Here is what to watch now. Daily CME open interest through February 27th. If it stays elevated into the final 3 to 5 days before first notice day, this stops being a scheduling anomaly and becomes a genuine exchange stress test in real time. EFP spreads between COMEX and London as the earliest stress indicator in the plumbing of the system. Shanghai behavior when it reopens February 24th. Does the Eastern physical premium widen further or begin to compress? Whether the implied volatility signal resolves through a sharp upside price move or fades quietly as paper sellers reload during the low liquidity window. Big Tech CDS for signals of broader risk-off acceleration that could trigger another paper liquidation wave across metals. Don't take my word for any of it. Pull CME open interest directly. Verify the Shanghai physical premium through publicly available exchange data. Read the official budget debt projections from the primary source document. Look at gold performance against every major currency simultaneously. Check the CME options chain and read the volatility surface yourself. The data is not hidden. It is sitting in public databases that most people will never open because the label on the door says, "Too complicated." It isn't. The ones who verified it are already 2 steps ahead. The majority will read the 40% down headline and conclude the bull market is finished. That's what the headline is designed to make them think. One question to sit with. If the options market is pricing more explosive upside potential at $74 than it priced at $121, and if Shanghai Physical is simultaneously trading 20% above its own exchange's paper contract, and if 294 million ounces of open interest refuses to roll 8 days from delivery, which price in this market has an expiration date on it? Invest with logic, not hype. OG John XX out.